Two Bulls in a China Shop is brought to you by these great companies that are giving us money to let you listen to their stuff.
Bullshit, Kyle. We make this show. You and me. Two Bulls in a China Shop is brought to you by us.
Someone's got to pay the bills, Dan, because it's not our trading.
All right, roll them.
Do you know how disaster relief organizations can turn a phone line into a lifeline? They use MasterCard Send to get humanitarian funds to the people in disaster-stricken areas, simply and quickly, right through their phones, so they can pay for fresh water, food, and hygiene supplies. Together, the possibilities are priceless. Learn more at mastercard.com/nextgensolutions.
This just in. Reportedly, pigs can fly. We're going live to... Can't take another crazy headline? Well, here's something you can appreciate. The MyGM Rewards card gives you best-in-class rewards with 4 points for every dollar spent everywhere and 7 total points earned per dollar spent with GM, bringing you one step closer to a new GM ride. That's the power of appreciation. From us to you. Subject to credit approval, terms and limitations apply. Visit mygmrewardscard.com.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face.
Well, hello and welcome, everyone. Welcome to the China Shop. You made it. Get on inside. We're kicking the doors open. Excited to have another special guest episode with you for today. I'm Shopkeeper Dan. With me, as always, is Kyle, creator of financialineptitude.com. Kyle, how are you doing today?
I've had better days.
Oh, yeah, that's right.
I think I just set a record for top ticks on my stops today. Oh, you serious?
Yeah. No, I blew through all my capital pretty early, and I'm just watching my levels play like champs for the rest of the day.
Oh, I hate that.
Make me cry.
Yeah.
Anyway, enough about us. It's not about us today. We're joined by Kevin Rendino, Chairman and CEO of 180 Degree Capital. Kevin, how are you doing today?
Hey, Dan. Hey, Kyle. How are you guys?
Not too bad. We're excited to talk to somebody who maybe isn't getting top ticked every day.
It's fun coming to the office every day, isn't it? I can't wait to get in.
Right.
Yeah.
So why don't you tell us a little bit about yourself, Kevin? I see you got quite the history of running some different funds with some big names.
Yeah, it goes fast. I was. It's been 30 plus years now. I graduated from Boston College in 1988 from the Carroll School of Management with a finance degree, and started my Wall Street career at Merrill Lynch Asset Management, which eventually became BlackRock. And I was there, really had one job for 25 years. I was an analyst on the fund that I ended up running. Mm-hmm. Left in 2012 and to find something else that I wanted to do, something more interesting than what I was doing at BlackRock near the end. Mm-hmm. And I ended up at 180 Degree Capital. So I've been an investor since the mid '80s. Seen a lot of weird markets, a lot of bear markets. This is another one. Lived through them all, though, survived them all, and we'll survive this one too.
Are you? I didn't hear you use the R word. You're not. Are you brave enough to call it a recession?
I already think we're in a recession.
Right?
Yeah.
Okay.
Yeah.
We're not crazy.
The look it up in the dictionary. Recession means recede, and when inflation is eating more than the economy is growing, you're receding. Mm-hmm. So from here, it's a matter of degree, but we're already in one. That's our view.
So what's the deal with the White House then? Why are they so hesitant to? Is that all to do with the election cycle?
Doesn't every administration look at the glass half filled and the positive?
Right.
Has there ever been an administration that was like, "Hey guys, we're fucked"?
Yeah, exactly. And this has been going on. We didn't have social media in the 1800s, but
this
has been going on since George Washington was in office. So
that's a good point.
Yeah. By the way, there are some positive things going on out there. I don't want to lose sight of that. I mean, it's a weird recession when you've got full employment and
right.
Yeah.
You've got people begging people to go to work. So it's a different kind of recession, but it's a recession nonetheless.
So you said you've seen quite a few different markets. Like, how does today's environment compare to anything you've seen in the past?
Well, we haven't seen inflation since the 70s like this. So this one is different in the big headlines, right? Because the only thing that matters is the CPI number when they report it once a month. But I've seen the same investor psychology around bear markets. So, that is all the same to me. In March of 2020, when we were in the throes of the pandemic, if I told you the S&P was going to be up double digits, 20 plus, if 2 of the next 3 quarters, you would have laughed. If I said in 2009, when the S&P was 6,666, that the market was going to be up threefold in the next 3 or 5 years, we would have laughed at that too. So, listen, investors trade on yesterday's news. Their time horizons, for the most part, are tomorrow's lunch. And they don't think through how different the world is going to be in 3 years. They just don't. So we think this is the end of the world, just like we thought it was the end of the world when the market crashed in 87, or when we had the Kuwait War in 1990, or dot-com bubble in 2000, or the subprime mortgage meltdown in 08. It's all the same at the bottom. And consumer confidence wanes. Investors flee from the market, and of course they do it at the wrong time. So this recession is different, but the psychology around the bear market is the same.
So what are you looking at then for your fund? Because it can't be easy for small caps at this moment, especially with rising interest rates and the threat of another rate hike from the Fed.
Yeah. So go back to when I said we left BlackRock in 2012. I had a great job. I was running $13 billion worth of money for BlackRock.
Oof.
Large cap value money, Graham and Dodd value. We're value investors over here. And I woke up one day and said, how much value am I actually adding to the Johnson & Johnsons and the General Electrics and the Exxon Mobils of the world? And I love the organization. I love my team. I love the people that I work with in our department. And I loved investing, but I realized it wasn't as much fun as it used to be, maybe because of Reg FD, and also because of this, train barreling down the tracks of ETF investing. And I worked for BlackRock, so there were, iShares, they were at the forefront of all of this. So I said, does the world need another large cap value manager who runs a diversified strategy, trying to beat the large cap value index by 200 basis points a year? And the answer was no. So I left. When I left, people didn't believe I was actually leaving. They're like, why would you ever leave this job? And I said, because I just have done, this has been a joyride for me for this long. I've done it fairly successfully. We've beaten the market. I just want a new adventure. So we ended up going to the microcap world. I set up a friends and family fund in 2012. It's called RGJ Capital. And we were focused on microcap investing, Graham and Dodd value approach with an activist bent. Involved in attempting to help a company engineer a 180-degree turn. And that could be running a proxy contest or just recommending a new CFO or an IR firm. Just all the years that I had at BlackRock of investing, trying to apply that to an asset class that was orphaned, essentially. Nobody covers it. Nobody follows it. And so I ended up joining the board of 180 Degree Capital's predecessor company. It was called Harris & Harris. It was a BDC focused on VC investing. Joined as a board member. The business was on its way to zero. I gave a board a strategy for how to fix it, which was kind of doing what I was doing in my retirement. And they asked me to run it. So since 2016, the beginning of 17, I've been the chief executive officer of 180. And we just invest in microcap companies. And the reason why we do that is because the risk reward is greater than the large caps.
How do you mean?
Because because the companies aren't followed by the sell side, because there's not a lot of eyeballs on the asset class because of the size. I mean, Fidelity runs $6 trillion. They don't have a fund. They can't have a fund big enough to invest in microcaps for it to be economically feasible. So there's just not a lot of funds that invest in market caps. As a matter of fact, if you look at the Lipper category, you'll be hard pressed to find 25 funds that focus on microcaps. Whereas if you look at the large cap core space or the large cap growth space, there's 300. So and the risk reward is just greater because nobody's paying attention. So if you get stock picking right, there's 100% upside in many of these names over a 3-year cycle. At BlackRock, when we invested something, the upside was 50% over 3 years. Now it's well over 100% over 3 years because it's just not examined and looked at in the same ways that the large caps are.
It's almost like getting it at the ground floor of something. Yeah,
it's just there's no index funds. We go to conferences. We're the only one in the room. If you look at the transcripts for the earnings calls, if you look at Apple's, for example, it goes on forever, and there's 10 analysts asking questions, and there's another 30 that couldn't.
Right.
With our companies, if we get one analyst on the call afterwards, that's like a celebration. And so that's why I'm doing it, because I think I'm adding value in a way that I just couldn't do at BlackRock anymore because of this ETF phenomenon. And so I don't love this environment in 2022. I've had enough of this. But in terms of what we're doing, we're loving the opportunities that this market's creating, and we've had a great run also since 2017. So, I kind of love my job all over again, and that's what I was kind of heading towards when I left BlackRock. I wanted to wake up and love my job, and now I do.
That's awesome. Recently got to experience that when when Dan and I tried to dive into doing this full time. It's got its struggles, but it's still the most fun and the most enjoyment I've ever gotten out of a job, I think.
Work.
Ever. Yeah.
Because it feels entrepreneurial?
Because I just enjoy it. Like, I just love everything about it. It just, I don't know how to really explain it other than that.
For me, it was funny when we were at Merrill. Mm-hmm. We got lucky because Merrill at the time was run at the end by Stan O'Neill, who literally in the course of 1 year, maybe 2 years of decision making, destroyed a company that had been around for 100 years, because he basically decided, I don't want to be in the asset management business anymore, which happened to have been our business.
Jeez.
Because it only grew at 15% a year, whereas the subprime mortgage market, that grew at 50% a year. Who wouldn't want to be in that business? So,
yeah, okay.
Right? So he sold our business to BlackRock. Thank God. He sold it we closed that deal in the fall of 2006. Oh. Fortunate enough to be able to have all my vested and unvested stock in Merrill vest in 2007. Mm-hmm. Happened to have been a year before the world ended.
Yep.
So while I'll always view Stan as being one of the world's worst executives, I kind of owe him.
He did you a huge favor.
He did me a huge favor out of his stupidity because he allowed me to monetize Merrill. And so I was at Merrill. I loved BlackRock. I absolutely loved Larry Fink. I love the whole franchise. They built that business from scratch, literally from scratch. But as I said earlier, by 2012, I'll tell you, I was in BlackRock's leadership, top 100 leaders, and we had a leadership meeting in Half Moon Bay in California. Mm-hmm. And I'll never forget it. This was during JP Morgan when they had the big bond meltdown. They had a bond trade that went awry. And that happened to have been my biggest holding at the time. And I was in Half Moon Bay with the team at BlackRock, not just investors, marketing people, and people, top 100 leaders. And we were debating, BlackRock's logo at this offsite. And while at the same time, JP Morgan was imploding, which happened to have been my biggest holding. And I remember saying to myself, I can't do this anymore. Like I can't, I'm not even investing the way I don't have, they're not allowing me to invest anymore the way I wanted to invest because I needed to do other things, suit things. So I literally went home and said no more. And I stayed for another year or so until they found my replacement. But then at the end of the day, it was the best decision that I ever made. It was a great career. I had a great run there. But leaving to do this, as it turns out, and having a second career has been infinitely more. It's fun. Not that wasn't fun, but it was not becoming fun anymore. And I recreated the fun every single day. So that's good for you guys if you've created that for yourselves, because it's important.
I just hope it doesn't end.
Yeah, right.
The world or the job?
Both.
I hear you.
Either, take your pick.
Yeah. Well, I've listened to a bunch of your stuff. It's really good. I wouldn't worry about it. You're very talented. So
I just need to figure out then how to get more people to hear it.
That's
word of mouth.
That's
the struggle.
Word of mouth. Keep it up. Yep. I'll help. I promise. After this, I'll get on Apple and do the reviews.
I got to ask you, you mentioned ETFs, the ETF phenomena several times here, and we just recently spoke with somebody who sees that as being the catalyst for the next major implosion or loss of value in the markets. And his reasoning behind it was kind of interesting. So I was curious if maybe you can clarify, like, how does an ETF or somebody who holds a fund, how do they handle like the voting of the shares?
Well, there's two different issues. Is his implosion, the implosion view, because he believes everyone's in a movie theater, they're going to yell fire and everyone's going to try and get out at the same time?
I think it's more that there's no actual governance really anymore because it's all in the hands of ETFs and funds. Like they're the only ones that have like the control to vote on the issues and affect real change.
Well, true. But most of these organizations, so that's not what I would worry about. I mean, BlackRock, Fidelity, Vanguard, they have their own internal governance teams that attempt to vote the shares of the ETFs based on ISS, right? Like they're not just rubber stamping votes at the end of the year. If ISS is opposed to certain companies' issues in a proxy, they'll state it. They'll say we support 1, 2, and 3, but we're opposed to 4 and 5. Well, BlackRock will also vote their shares the way their governance teams suggest they should vote. So it's not like they're not paying attention to all that stuff.
And the more I think about it, it makes sense that, I mean, they have a vested interest in that company continuing to be run and managed well.
100%. And you listen, go listen to Larry. He talks about governance all the time. He talks about the environment all the time. He talks about a lot of the issues around investing in 2022 that aren't just about whether or not a stock price is going up or whether a management team's compensation is acceptable or, so there's other factors. Obviously ESG has a huge weight.
Right.
So that's not what I would worry about. What I would worry about with ETFs, they're black boxes. They don't do anything other than if they get money in, they buy the market. If they have to redeem at the end of the day, they sell the market. And what I would worry about is we're overexposed to a bunch of boxes. And if we all decide at the end of the day that we want out of the market, then the machines are going to crush the market. I mean, that's what I worry about with ETFs.
Just outsized positions.
Correct. And they are outsized. I mean, if you look at the holdings for almost any company, and you look at the top 2 or 3 holders, picking up IBM right now, Vanguard's 1, BlackRock's 2. That's 16% of the equity. State Street's 3, by the way.
Right.
They're all index funds. So what's interesting, though, is because we're activists, and I don't do the large space because how much change can you actually affect? That's why I'm doing it with microcap companies, because I can affect change very easily down here. On the large space, I mean, there's the big, whether it's Janus or the other activists, they can still affect change, even though they own maybe 2 or 3% of a company, but they've got to be able to convince State Street, Vanguard, and BlackRock that the board should be thrown out. And that requires meetings. Like when I was at BlackRock, we many times would sit down with Janus, who was running a proxy contest against a certain company, and we would hear their pitch, and then we would vote. So activists can still have a place to ensure that governance is proper for many of these large cap names. They just may have to convince some of these behemoth holders that their views are the right views. Right.
You almost need a uber rich person to be the one trying to go and affect it, like a Carl Icahn.
Yes, he's loud. He's proud of being loud, and when he gets involved, that's going to draw. See, BlackRock and Vanguard and State Street are just never going to be public about it. Mm-hmm. Which was another reason why I left, is because I wanted to do activism. I couldn't do it there,
right?
Because we were able to write letters and vote our shares in a certain manner. When I was at Merrill in the early days, I mean, one of my great heroes in investing was Arthur Zeichel. He basically was the founder of the Merrill Lynch asset management business back in the 70s. He was an old Dreyfus guy, great value investor, Graham and Dodd value investor. So he was the Targaryen of the asset management business. Yeah, there you go. Of Merrill Lynch. But there was many times where we would go into meetings and say, we're going to write a letter to, I'm just using IBM as an example. And he'd be like, not. And I'm like, what do you mean, no, we're not? He's like, if you don't like the way a company is being run, you vote with your feet.
Oh, you just pull your capital.
And that was just his view, that he didn't want to get involved. He didn't want to be messy. Remember, Merrill also had a big banking business.
Right.
He didn't want to screw that up for the bankers. So that was part of the problem, was being around a diversified company that had different interests and different businesses that relied on these corporate entities.
Right.
So he didn't want us to do anything, and BlackRock didn't want us to do anything really either in terms of it being public.
Right.
We were at least allowed to write letters and get our hands dirty a little more behind the scenes, but as far as making a public stink, we couldn't be Carl Icahn or Harry Rosenstein at Janus or anything like that. So,
but now,
that's why I knew I wanted to leave, because I wanted to do activism. I wanted to be public about some of the companies that we're investing in. You've seen that in whoever's listening to this. After you can go to just Google 180 Degree Capital or Google some of our holdings, and you can see some of the public letters that we've written. So we will get loud around some of our holdings if we think they're not being governed properly.
What sort of things, what sort of things do you get vocal about? Like, what do you need to see in order to try to go and affect some sort of change?
When we think that a board is not running the business for common shareholders, or when we think the purpose of a board is to oversee the running of a business and to create value for shareholders, right?
Right.
It's not necessarily to run the business day to day. That's why they hire the CEO. The CEO hires a team, or he or she hires a team.
Mm-hmm.
And then it's the board's responsibility to keep score on how the management team is doing. And if they don't like the job that the management team is doing, or the management team isn't created value, then it's their responsibility to go find another team.
Right.
And it's their responsibility to create value for shareholders. It's not their responsibility to be friends with the management team.
Yeah.
Or be in the pockets of the management team. It's not their job to rubber stamp everything that the management team is asking them to vote on or budgets to approve. So, for example, ComScore is a name that we own. And, ComScore has a great, wonderful business. They probably them and Nielsen are the two biggest companies. They measure audiences, brands. It's a ratings company, right?
Oh, okay. That's ticker SCOR for anybody who want to look it up.
SCOR, yes. They've got great data. Nielsen's really messed up in the last 3 years because during COVID, they were basically providing false numbers, and companies were having a hard time of ascertaining their own business because they were relying on Nielsen data that's sort of gone awry. Mm-hmm. So the industry is rebelling against Nielsen, creating more opportunity for a company like ComScore to take market share. Problem with ComScore is it used to be there was an activist involved, and they basically they had a stranglehold on the company's finances. They wouldn't allow the company to invest the way that they needed to invest. And a new set of shareholders came in, 3 of them, Cerberus, Liberty, and Charter.
Liberty Steel?
No, Liberty Global.
Is that the one that Gupta?
John Malone's company.
Okay, not the steel industry.
No, the telecom company, Liberty Global.
All right.
They came in. They took out Starboard Value, who was the activist. Who really? I mean, I respect I love the guys at Starboard, but with the ComScore, they unfortunately they didn't get the job done. Mm-hmm. These preferred shareholders came in, and they were going to be the investors on the white horse that were going to save it. And everything they've done up until the last couple of months has been nothing. I mean, they literally have done very, very, very little other than collect the dividends that they're entitled to get paid.
Right.
They were basically overseeing the business with only their perspectives in mind, being the preferred shareholders, where, as I said, they each took a 16% stake in the company and they got paid their dividend, but they weren't affecting change at the company.
Right.
The company needed a new CEO. Bill Livick, who is the prior CEO, is a tremendous name in the business, but he was not the right person to take this company from where it was to where it was going. He spent a little too much time pontificating about industry trends and not enough time worrying about the income statement and cash flow. Mm-hmm. And so we kept encouraging the board to do something about that, and they were very reticent to do that. We asked the board to convert some of their preferred. ComScore got kicked out of the index, or was going to get kicked out of the index in June of this past year because their market cap had declined below the set limit.
Right.
Because they don't count preferreds as part of the capital structure.
Okay.
And so we asked, which is kind of silly because preferred is more senior to common, and it is part of the capital structure, but they don't make Russell makes the rules, and they don't calculate preferred holders. So when preferred holders came in and took basically half the company and took the common and turned it into preferred, it killed the market cap of the company, the common market. And so we said, listen, you guys are about to oversee you getting kicked out of the index, which is not a good thing for you.
No.
And we want you to convert some of your preferred to common. And they wouldn't listen. And the company did get kicked out of the index in June. And they had it within their sites to save the business from getting kicked out of the index. We've already talked about the indices and why they're important, because that's where all the flow. Mm-hmm. So we got very agitated with the board for not focusing on all shareholders, but only focusing on preferred shareholders. And we started writing letters, public letters, and we told the world that they're not doing their job as overseers of this business. And they're responsible for the destruction of value that we've seen in the last year and a half because of their inaction or slow behavior.
Right.
And since our letters have been written, what you'll see is a new CEO, a new CFO, an entire new management team, a new chairman of the board.
A new CEO, a new chief innovation officer, I see.
Yeah, you got it all.
Yeah.
And you also see Cerberus the chairman of the board was a service appointed person, but you've actually seen Cerberus go into the open market and buy common stocks. And they did not convert what they had.
Mm-hmm.
And by the way, I didn't want them to convert and not get paid for their conversion. I just wanted them to align more with common shareholders.
Right.
And so they didn't convert. But what they have done is they've gone into the open market and bought common stock. So you'll see, if you look at the 13D filings, or the Form 4As, I should say, S4s, you'll see that Cerberus bought $1 million worth of stock in the open market, not in the not too recent past, I think in the last 3 weeks or so, at these prices. So
is that the volume spike I see on like the 23rd of June?
Yes.
Yeah, okay.
Oh, no. The volume spike that you see at the end of June 23rd was them getting kicked out of the index.
Oh, okay.
That's what that volume spike was. You'd have to go find the day that Cerberus bought to see what the volume was, but it was no. That volume spike was the index adjusting to the fact that ComScore no longer is in the index.
Mm-hmm.
That's what that was. So listen, what we do at 180, we try and buy real businesses with real franchises that have been mismanaged, where we think if there's effective change that takes place that addresses the reasons why the stocks are down to begin with, then you can have a 1x, 2x, 3x type of return. And ComScore is a great asset with great data assets. It's not like they're losing money. They actually throw off $35 million worth of EBITDA.
Mm-hmm.
Now they're in the hands of somebody that is very anxious to improve the business model. They're making all the right decisions management-wise and with the income statement. They're going to cut some costs here in the not-too-distant future. And we think the stock has a chance to double or triple, not just go up 20% or 30%. So
right.
That's kind of what we do for a living. And we try and help get the change afoot. And in this case, we can't run a proxy contest against ComScore because we're just not going to win because the preferred shareholders
right.
own half the business. But we can encourage them to do the right thing for shareholders by being public. We did so, and now they are, and we're thrilled.
Well, and with the smaller company like that, when you're talking about microcap, like you said, like the Johnson & Johnson, you're not going to get them to budge by throwing a public spat. But when you have a smaller company like this, it's a lot easier for you to even work with them. Like, hey, here's the things that we see that are wrong, the ways that you can improve. This would be our recommendation. You can have a dialogue with them, whereas Johnson & Johnson may not even pick up the phone.
That's right. And activism has different connotations to different people, but we're collegial and collaborative. Like we actually aren't Carl Icahn.
Yeah.
Because Carl's not collegial and not super collaborative.
No, he's more ultimatum.
Yes. And we're not that way. Like when we show up at the doorstep of a business, it's because we want to own the business and we think there's a couple things if the company does it, that's going to allow the business to engineer that 180-degree turn in its business. So we're just there to help. I would like to think that my 35 years of experience being an investor could be useful to some of these companies, especially the small ones that don't know how to be public. They don't have a good IR firm. They don't know what it's like to make proper capital allocation decisions. Some of the boards are, the companies were private, then they become public. The boards reflect the business that it looked like when it was private. Maybe some of the board members are friends with the CEO and they don't have the right skill sets to be a public company board member. And so we're just there to help.
Yeah.
We don't actually, we sit on many of the boards of the companies that we own, but we've never done a proxy contest, ever. Because we haven't had to. The boards actually welcome us onto their boards. So whether it's TheStreet.com, which, we went on their board and we ended up selling the company, or Synacor, we went on their board and we ended up selling the company, or even board observer roles like Sonam or Arena Group. Like we were asked to go on. We didn't have to demand to go on, and nor did we have to run this, a public proxy battle, which is just time consuming for us and it's time consuming for the company and takes away from a management team's ability to run their business properly. So we're collaborative, collegial activists. We're not jerks. Now, we can be jerks,
Right.
but we don't start off as wanting to be a jerk. We start off where how can we help you? Can we maybe solve your capital structure problem? A couple of our companies, TheStreet.com, and we own Turtle Beach, they had these senior liquidation preferreds that were overhanging the equity price. And we took the preferreds out with our capital. We replaced the preferreds with common stock, and the stocks were off to the races right after we did that. So we're truly there to help.
Like, it seems like it's a much better environment to be more collaborative and cooperative like that. Like, if it gets to the point where you're going to have to start demanding and being more combative, like, what's the chances of the turnaround happening at that point? Because even if they do, if you had to go the proxy route and force a seat on the board, like, are you still going to be able to affect change, or is everyone just going to be
That's right.
defensive and not wanting to work together? Everyone's just going to go into their shells and try to protect their jobs, basically.
Yeah, that's why one seat on a board of 7 doesn't really matter all that much from a voting,
especially if they don't want you there.
Exactly right. If they don't want you there, and you'll be the person in the corner that everyone is going. The fork in the road. Everyone goes left, and I'm the only one talking about why the company should go Y, and
right.
Tell you to pound salt, and that's the end of it. So. And then, once you're on a board, even if you own 10% of a company, we own, 5, 6, 7% of companies.
Mm-hmm.
Now you've got 2 hats. You're a shareholder and an investor, and now you're a board member. And so you can't send the ComScore letters out to the public if you're a board member. You just can't do that. It's not proper. If you're a board member, you're there you're there as a board member to support the management team and work with the board to create value. You're not there to become an outcast by writing public letters. You're wearing 2 hats. So and here's the other thing. When you're on one side of the wall and you don't know how a company is being run. We can show up thinking that this company has enormous value if they do X, Y, or Z, but we're not behind the curtain. We don't know where all the skeletons are buried. And to think that you can show up day one and demand that a CEO be fired or demand the board be replaced without knowing what the consequences of that action would be and how that would affect the equity price is just being arrogant.
That was the word I was looking for.
That we don't know, if that makes any sense, or we know what we don't know. We don't know a lot when you're on one side of the business and you haven't signed a non-disclosure, an NDA, where now you're under the hood. So some of the stuff that we've done from a activist perspective has been after we signed an NDA, after we had access to a company's results, after we had access to a company's strategy, and that's when it becomes collaborative and collegial. If we've signed on to what their strategy is, and then we can go on and help them.
So why would you be willing to weigh in on your thoughts on Elon Musk buying Twitter and then backing out, saying once I looked at the books, I'm not in?
I have a lot of respect for people who are as smart and creative and have built businesses from the ground floor. Mm-hmm. And Elon Musk obviously has my respect from that perspective. And I would, Tesla's an unbelievable company, and we can argue about the valuation, but look what he's done, SpaceX and the rest. But honestly, when it comes to Twitter, I mean, he should put the red nose on. I think what he's done there is disgraceful. Is utterly disgraceful. And I don't care about the whistleblower. The whistleblower was there to talk about a lack of security, which is a business issue.
Right. Yeah.
But when you buy a company, you're bound to buy that company. If you're going to walk away, then there's a breakup fee, unless there is an MOU. And in this case, there isn't. From what I can tell, there's no fraud at Twitter whatsoever, and there's no basis for him breaking his promise to buy the company. That's my opinion. And I think him lobbying, his whole using Twitter while he's buying Twitter is odd.
That seems really weird, yeah.
And so I have no respect for how he conducts himself at all. I think he's a child in many, many ways. And like I said, he's an unbelievable business operator and an unbelievable entrepreneur. But that doesn't mean that you can go on Twitter and say whatever the frick you want to say whenever you want to say it, especially when you're buying a company. I think he's. I see. Look, I love to bet. I'm a DraftKings person. I love sports, and there's nothing I won't bet on. If I had to bet on it, he's going to be paying Twitter $1 billion check. And I'd be shocked if he's not.
Yeah.
Do you guys share the same view or no?
I have a hard time seeing how he gets out of that deal. I can see why he would be upset at the bot issue, but he needs to provide some sort of evidence to the contrary, and that shouldn't be going on in public either.
Yeah.
Like, it feels more like he's just trying to get a lower price because the price tanked after he agreed on a price that was way above the market value.
Yeah.
Buyer's remorse.
Yes.
Total buyer's remorse. It's too, I mean, you know what he'll probably end up doing? He'll probably build a business to compete against Twitter, right? I mean,
That's why I brought it up, because listening to you talk, my first thought would be, well, if he looked into the company as he's buying it, like, wouldn't he want to fix that problem? Like, okay, well,
right.
I'm here to fix Twitter and make it better. Like, it feels really disingenuous to be like, oh, now, yeah, you're not what I thought you were. Get out.
Yeah, there needs to be, as you guys know, there needs to be something has to happen, a material change that has to happen for lawyers and a court to basically walk away from what the inevitable breakup fee is when you're doing a deal.
Yeah.
And I don't really have a lot of respect for how he handled himself throughout that. And that's just my opinion.
You're going to make a lot of friends in the China shop.
I don't own Tesla. I don't own SpaceX. I don't own Twitter. It's not. And I had no stake in the game,
right?
Skin in the game on either side. It's not a proper way to. We believe in proper corporate governance, and from a company, we also believe that investors should be proper in their behavior, also. And I think there was a lot of improper behavior by him.
Yeah.
Okay. All right.
Dan, are you taking notes? Because that's the way to start beef.
To start beef? Yeah, right.
That's
right.
how you do it.
All right. So back to corporate governance. Carrying a samurai sword at work when you're the boss. Thoughts?
Who's carrying a samurai sword?
Zuckerberg.
Oh, I did. I don't know. Here's another one, by the way. Now, we can argue whether or not he stole Facebook from the Winklevoss twins.
Yeah, that's right.
But I can't. I mean, it seems like he's getting weirder and weirder in his old age, too.
I just listened to him on Joe Rogan over the weekend. That was quite a fascinating interview.
I didn't hear it. So what did he sound?
He actually sounded well composed. He just is completely sold on this VR reality and that everything is going to be moving into a virtual space.
Yeah, now, look, I'm 56, so I'm not going to be buying real estate in the VR world.
In the metaverse? Yeah.
Okay, I don't even know. I feel like that's going to end badly for a lot of people. Just listen, you guys have seen bubbles before. Bubbles, they're different things, right? Like, it started with the gold rush way back when, tulips, and we had a .com bubble, subprime mortgage bubble, crypto bubble,
tech bubble.
This is all yeah. And so the VR thing feels like cannabis bubble. That just feels like, first of all, I'm not going to be able to understand it, nor do I want to.
Well, here's the thing with Musk that I always go back. Not Musk. I'm sorry, Zuckerberg. Now, you mentioned the controversy around the starting of Facebook in general, but what thing has he done with Facebook that was innovative and first? Because most of the things that he's tried to pivot the company to that I've seen is they fail and then they go out and just buy somebody else that's doing it better.
Like Instagram, like
WhatsApp.
Yeah. No. Well, whether he created it or not, he created Facebook. So that's what since then.
Yeah.
Again, we can argue, did he do it or did the Winklevoss twins do it? But either way, he did that.
Yeah.
But I would agree that has run its course, and I don't see this VR strategy. That's not why people own metaverse.
No, they own it for the data that Facebook collects.
Exactly. So he's also got a time horizon probably of 50 years.
Yeah, right. I don't think I do anymore now either.
Yeah, that's not why people don't own metaverse because of virtual reality. So he's paying up for assets. That's for dang sure.
Yeah.
And whether they work or not, I don't know. But he was successful once. I guess I don't necessarily think I want to bet against that, but I don't see how this also, the thing that he was successful at, you can monetize and you can have an income statement around it that resonates with shareholders, investors.
Right.
The other strategy doesn't feel like it's got teeth with regards to revenues and earnings and cash flow and the rest.
Right. But doesn't that usually come later in those types of innovations? Yeah,
of course. Yes, they do. There was a lot of TV manufacturer in the 50s that weren't around in the 5 years later because everyone was trying to make TVs at the same time. So It does come later. In this case, people would be betting on the later. But just because it's like the .com in 2000. Yeah, we could have had a similar argument. Well, this will all come later,
Right.
And it ended. So yeah, of course there was companies that were successful that came out of that, but it feels like 98% of them, went bust in a year. So I'm not saying he's going bust in a year, but you better be careful about the billions of dollars of investment he's going to be making if it's going to impact the income statement. Because at the end of the day, he runs a company that has $146 stock price that's dependent upon current valuation also. So you can't R&D your way to an industry that doesn't exist quite yet and maintain a $146 stock if your earnings are going to go down. So again, nothing but respect for that guy and what he's done. It feels a little off the beaten path right now in terms of what he's doing. Away from the core.
Yeah, I'm definitely not a fan of the man, and I've said it pretty vocally, trying to start beef because if Facebook ever mentioned us, we'd blow up. I like Kyle alluded to. I haven't seen any real innovation come out of that company, in my opinion. It just seems maneuvering.
It's just a marketing machine, and basically, a lot of their customers can't stand them. They just had to deal with them. They didn't have a choice.
Yeah.
And so there's a little bit of pushback there on that. You will do X, Y, or Z, or you will not be featured. That doesn't work with the Procter and Gamble's of the world forever. And then, of course, there became issues with their security and the rest. So there's it's almost, I don't want to call it Nielsen, but they're experiencing a lot of pushback from their end users or their end customers who advertise with them because of their sort of monopolistic behavior and attitude in the last 5 to 7 years.
Wanting to ask you, going back to Turn's strategy, and Turn being the symbol, if we hadn't mentioned it yet.
Yes.
For 180 Degree Capital, but do you focus on like specific sectors? Like, do you feel like you get a better read or understanding of certain sectors, or do you have a set criteria that you look for when you're trying to pick some of these stocks that you think are ripe for a turnaround?
So what we are Graham and Dodd value investors. When we buy something, it trades at 2/3 the market multiple in either price to earnings or cash flow, half the market on price to book, above average yield, one-time enterprise value to revenue. Those are the screens that we run. I've always been a value investor. I come from the Columbia School, New York, NYU Stern School of Graham and Dodd. Benjamin, for a long time, I think my kids thought that Benjamin Graham was like my uncle. No. I would talk about him so much. So it doesn't matter the industry as long as the stock fits one of the screens. Now, we do have a proficiency of being better investors in industrials and materials, in information technology, energy, financials, less so healthcare. Biotech is it's never going to fit my value orientation. These companies are here for the promise of tomorrow. And
yeah, they're lottery tickets, basically, right?
Yeah, exactly. We don't invest in lottery tickets. We don't invest in ideas. We invest in real companies with real balance sheets, with real businesses, with real management teams. And so infotech, industrials, and materials, parts of consumer discretionary represent most of the value of our holdings. Mm-hmm. You look at our companies, Comscore, Arena Group, Lantronix, Quantum, Synchronous, Alta Group, Potbelly, they all sort of are in the same 4 or 5 industries.
Okay, so I was looking at the right. Yeah, I was going to ask you about Arena Group then, because that was a healthcare company, or at least it's listed as one.
Arena Group is the old Maven. Maven is a technology platform company that runs the digital sites. Like they run the digital business for Sports Illustrated. They run the digital business for the History Channel, for Biography.
It's definitely not healthcare then.
For TheStreet. Yeah, it was called the Maven Group. They did an uplist recently. They changed the name of the company from Maven to the Arena Group, and the symbol from MVEN to AREN. So AREN was a healthcare company before. Is that right?
Oh, so they just haven't updated it yet?
Probably.
All right, that makes it says cable and other pay television services in the summary of it. But
no, Arena Group is a media company that I said runs the digital assets for a lot of brands that you and I know. Mm-hmm. They're essentially the technology backbone.
Are there any specific sectors that you think are going to outperform going forward?
I do think when the dust is settled, I think most of these supply chain issues that have plagued the information technology world are COVID-induced, COVID problems. The economies have obviously done quite well throughout COVID. Mm-hmm. From a demand perspective, it's been these countries that manufacture chips that don't have the same vaccination rates across their country that the U.S. does, for example.
Right.
Stay-at-home orders are still taking place. So we think the information technology world has been crushed by, trying to find demand from countries that are still experiencing COVID more than we are. We think that's likely going to play itself out in the next 2 or 3 months, and the stocks have gotten demolished.
I was looking at some of those, and they're actually either near or below some of their COVID lows.
Yeah, many of them are all-time lows. Mm-hmm. All-time lows, despite the fact that they're still reporting pretty decent results. So our thing with information technology has always been, even going back to the 80s at Merrill and Blackrock, they're cyclical.
Yep. And
people forget they're cyclical. You buy them we buy them when everyone hates them, and we sell them when everyone loves them.
Right.
And valuations get extreme on both ends because of the sexiness of their business. So, I've invested on and off in Micron for 30 years. And at the bottom, it's the worst company in the world, and at the top, it's a monopoly. And reality sits somewhere in between. So
right.
It's like that for all of our tech stocks. So we like, and they do offer growth aspects to their business, honestly, but we like to buy them at value prices. Mm-hmm. So that's why we like technology. But we only like it after they've gotten slaughtered, like they have since November of last year.
They still got room to go, it looks like, too.
They could.
Some of them.
Yeah. Oh, to the downside, you mean?
Yeah.
Yeah, I'm never good at picking bottoms or calling bottoms. I'm good at picking bottoms, if you give me a few months. Picking the exact day, I don't care what the exact day is. Like if I think that Lantronix is going to 10 at 513, I don't care if it's really going to 480 first. We're investors.
Right.
And I can't control what somebody else is going to do with their Lantronix holdings tomorrow because they got some redemption and they have to sell it. Mm-hmm. And they don't care about the business or the price. They know they have to sell it. So when you get into these kinds of markets, the good news about 180, we have permanent capital. Mm-hmm. Nobody can take away our money. And that bodes well for us during dislocation periods like today because everyone's getting redeemed. People have to sell. everyone's scared. They sell it they throw the baby out with the bathwater, and we sit there with the bucket
and just try to catch it all.
Yeah,
the water, not the babies.
Yeah, right. Of course,
the valuable stuff,
priorities.
Exactly. So I, on the one hand, I hate this period. On the other hand, I'll look back in 3 years and I'll be like, thank God we had it.
Yeah. I wanted to follow up real quick with the semiconductors before we wrap up here. I was curious if you thought the Ethereum or cryptos had anything to do with the semiconductor shortages, exacerbating at least the supply chain issues. And if so, do you think like the merge with Ethereum switching away from basically, I'll put it in layman's terms, like you don't have to mine it anymore, so you're not using graphics cards like the same way Bitcoin is. Like if that should help alleviate some of that stress of the supply chain.
If you were in fact aware of those things.
Oh
yeah, no, I'm quite aware. I think they're for me. I do think it alleviates. But I don't. What matters the most for semis, in my mind, is the growth in the actual economy. Mm-hmm. Like Ford can't make enough cars right now because they can't get enough chips.
Right.
That's not good for the semiconductor industry because cars are now becoming computers. Mm-hmm. Airlines are computers. IoT, the Internet of Things, is a real thing. So whether it's data centers, data warehouse builds, all these things we're using more and more silicon than we've ever used before, and we will continue to use more and more silicon. Storage obviously requires more and more memory than we've ever had before. I think semis, this is why I get back to my comment before about their cyclicals. They really are economically dependent. One of the reasons why they've gotten hit the most is because they are economically dependent, and they did have rich valuations. And if the world's worried about a recession, then semiconductor sell-off is going to continue. So I think I think the real economy matters more for the semis than does the crypto world. I don't know if that really answers your question, but that's kind of what our view is.
Sounds good to me. Dan, do you have anything to follow up with?
No, so if I had $500 and I wanted to be a millionaire tomorrow, do I need to rob a bank?
Yeah, I 500 and I'm trying to find. I guess you had a few months. You can bet on like Jacoby Brissett to win the NFL MVP. Yes. All right. Okay, Jacoby. I'm trying to think of where the highest odds are for any bet in the world, or you can go get a lottery ticket.
I need to go on DraftKings. You're saying that's where I'll do that.
Or you can do the smart thing, and you don't have to become a millionaire tomorrow. But you can buy Turn stock at $5.80 when our book value is north of $8.35. That makes sense.
Whoa. Okay, so you're saying they're having a fire sale on shares of Turn right now.
Turn, yes. Turn is, go look at our S4s. Look what I've been doing personally. Or
I did see a bunch of insider buy alerts with your name attached to it.
That's right.
I'm going to have to file a 13D at some point if this continues. But I believe you put your money where your mouth is, and if you're going to run a publicly traded company, you better have skin in the game. Yeah. And at least your shareholders know that you're aligned with them. So
right.
I like stocks that trade below cash per share. Cash and liquid securities per share, we do, and I like stocks that trade at $5.87 when book value is well north of $8.
Right,
it doesn't make any sense to me at all. So I'll do that all day long, and I'll probably go down a nickel a day until I'm broke. But I know I'm going to get paid for this investment.
At some point it may be a little while, but you have time frame.
Yeah, I'm not going anywhere.
Yeah. One last time, can you tell everybody where they can find, if they want to learn more about 180 or follow you guys on any socials?
Yeah. 180 the number, 180degreecapital.com is our website. You could see our holdings we're very transparent about everything we do. We tell everybody what we own. Some videos on there about our process. There's some investment marketing decks in there that really go into depth about what our performance has been and how we think about investing. It's a pretty comprehensive website. So go there. You can always listen to our conference calls that we do every quarter when we report our earnings. Some say I have interesting shareholder letters. You can retrieve those on Edgar or on our website. And then on Twitter, once a month or so, we'll write a white paper on the industry, and you can see that at 180 Degree Cap on Twitter.
180 Degree Cap. Make sure links for all that stuff are in the episode description.
Absolutely.
And I really enjoyed this. This was my favorite hour of the week.
Fantastic.
Yeah, I'm glad we persevered because there's a little bit of a snafu trying to get you in the shop initially.
No, I really enjoyed this conversation. I'm joking. It was one of my favorite hours of the year because at least for 1 hour I didn't have to stare at my screen, and that's a good thing.
One of my favorites too. Man, we'll have to get you back sometime.
Okay.
Dan, you want to take us home?
Okay. Thank you again, Kevin. This has also been a really fun hour for me. I feel like I've learned a lot. Thank you, listeners, for sticking around to the end. We hope you enjoyed this interview. I know I'm checking out Turn. I got this. I've been staring at the stock ticker the whole hour. That's why I brought up the $500. I'm really glad that you hit that one out of the park. That was great. Yeah, just great time. But unfortunately, we do have to always close up shop, and we've hit that time. So thanks for sticking around. Like, share, subscribe, rate, all that amazing stuff. You know what to do, dear listener. You know what you're doing. We'll be back at you soon. Until then, happy trades.
Bye, everybody.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks in the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
Your favorite band's about to play a sold-out show, and you definitely got tickets. And drinks. Now hurry and make it back to your spot. Past this person and that person. About 20 more. Ooh, watch out for feet.
Hey.
Just keep going. A little further. Oh, there's your friend.
Over here.
Right where you want to be. Close enough to see the set list. And they're definitely playing your song. When you're with Amex, it's not if it's going to happen, but when. American Express. Don't live life without it.
This just in. Reportedly, pigs can fly. We're going live to... Can't take another crazy headline? Well, here's something you can appreciate. The MyGM Rewards card gives you best-in-class rewards with 4 points for every dollar spent everywhere. And 7 total points earned per dollar spent with GM, bringing you one step closer to a new GM ride. That's the power of appreciation. From us to you. Subject to credit approval, terms and limitations apply. Visit mygmrewardscard.com.